Well, good afternoon, everybody, and welcome to our latest investment panel debate. For those of you who don't know me, my name is Mike Deverell, and I'm partner and investment manager here at Equilibrium. Now, today, we're going to be discussing how to manage portfolios through uncertain times. And we certainly have a lot of uncertainty right now. Clearly, the conflict in Ukraine is hurting markets, but we've also got concerns over a cost of living crisis that are affecting market returns. So to analyse all that and go through all that, I'm delighted to be joined by two absolute experts in their field. Firstly, we have Gervais Williams, who's head of equities at Premier Miton, sorry. Gervais is one of the foremost investors in UK equities, and particular an expert in investing in. Those of you who've joined previous events will know he always goes down a storm. So thank you for joining us, Gervais. Secondly, we also have Hugh Gimber, who is Global Market Strategist at JP Morgan. Again, Hugh's joined us on some of these events before the world. So I'm really looking forward to hearing what you've both got to say. And thank you very much for joining us. Today, we've got 45 minutes and lots to go through, so it's going to be pretty fast-paced. In essence, I want to break the discussion down into two main parts. Firstly, we're going to look at the war in Ukraine and what implications that has for portfolios and how we manage those portfolios when times are so uncertain. We're not just going to talk about the short-term implications, though. We're going to look at if there's any long-term impacts. For example, are we seeing a reversal of globalisation trends? Does that impact other countries like China as well as Russia? And then the second half, we're going to discuss inflation. Are we seeing a cost of living crisis here in the UK and globally that may have a serious impact on the economy? Is inflation here to stay, or are we just seeing lots of temporary factors all occurring at the same time? And what sort of investments do we want to hold when inflation is high? So those are the sorts of things we want to discuss, but we'd also love to hear from you. So if you want to ask a question for any of our panelists, please could you press the Q&A button on your screen at any time in the presentation. And then at the end, I'll be joined by my colleague, Ben Rogers, and he'll help to go through those questions and put them to the panelists. So without further ado, let's crack on with our first subject, which is managing portfolios in uncertain times. So the war in Ukraine's had a big impact on markets. We saw stocks fall sharply after the invasion, and we saw energy and commodity prices spike. But gradually over the following weeks, we think things have settled down a little bit. Stock markets have recovered some of their lost ground. So what I wanted to ask is, how do you manage portfolios and make decisions, investment decisions and buy and sell decisions in a period like this? There is so much we don't know. We can't possibly predict what's going to happen with the conflict, whether it's going to end tomorrow or escalate. So how do we know what to buy and sell? How important is it to perhaps actually ignore some of that short-term noise and maybe focus on long-term trends? So Hugh, I want to come to you to begin with. What are your thoughts on that? How do you go about managing your way through such uncertainty?
Sure. Well, thanks for having me, Mike. It's a pleasure to be back speaking with you and your clients today. I'd make a couple of points here. So number one is that I think whenever markets get more volatile, you have to be absolutely crystal clear about the time horizon that you're working with. Because you've described there a period of what's really only about 6 weeks, where sentiment on the Ukraine conflict from a market perspective has been swinging very, very wildly. And so obviously the danger is that you see stocks fall one day and you say, right, well, now's the time to be turning more defensive and turning more bearish. And then you see them bounce back the next day and you've been whipsawed, as we'd call it. You get swung around by these rapid changes in market sentiment. So for most of the clients that I speak to, they're looking at a time horizon of maybe 5, 10, perhaps even longer in terms of 15, 20 years out. Getting involved in the day-to-day swings in markets is probably not going to be the right thing to do. So I think you have to be, number one, crystal clear on your time horizon. If you're a long-term investor, you need to be focused on making long-term investment decisions. Second point is be crystal clear about what you know and what you don't know. So we've all learned this year that trying to predict the path of the Russia-Ukraine conflict has been nigh on impossible. Okay, you could have been speaking to the best geopolitical experts in the world 2 months ago, and you still would not have called this outcome correctly. So be crystal clear that you cannot predict where the politics is going, but what you can say is A, how strong was the economy going into this? How resilient was the consumer going into this? 2, what's the transmission mechanism for these headlines to make their way into markets? And that for me is through energy prices, because from a market perspective, this is effectively a supply shock for commodities that are produced in Russia and now may not be making their way to other parts of the world. And then C, what's the policy response going to be? So is it really going to be consumers and corporates that have to take the hit from higher energy prices, or might it actually be governments? Might we see more this year with governments trying to step in and shield consumers and corporates from the full impact of this shock in the same way that they did in 2020 with COVID? And that policy response, as we've seen historically, can shift market sentiment dramatically. So be crystal clear on time horizon and be really clear on what you know, which is economics and the market side of things, and what you don't, which is likely how this political conflict is ultimately going to play out.
That's really interesting, and I think I'd echo a lot of those thoughts there. So Gervais, over to you. And you know, accepting what Hugh's absolutely rightly outlined, that there's so much we don't know, but has the conflict given you the opportunity perhaps to buy something that you might have thought was good value anyway, but get a better opportunity to buy it at a better price?
Yeah, I mean, I think the nature of fund management is that we're here to make serious money for your clients. Obviously, that's the number one aspect. But the other feature is actually we're here to actually manage risk. And if we can limit risk and have it spread across a number of investments and different asset classes and such like, of course, that ultimately helps. And the great advantage of being invested in a fund which has quite a long list, the portfolio tends to have about 130, 140 holdings, it means that ultimately we actually don't have to worry about changing the portfolio very much, because each little holding is relatively small. And so ahead of the Russian crisis, you know, we always worry about downside. I'm probably too worried about downside as a fund manager compared with many others. It meant that actually when we looked at some of the Russian companies, and there are some UK quoted companies, if you remember, you know, Polymetal was actually a FTSE 100 company at the time. We just looked at we did have Polymetal. It actually happens to be quite a strong business in the gold mining sector. It happens to have an exemplary sustainability report. But ultimately, if things turned bad in Ukraine, we always knew that the downside would be quite significant. We didn't know if it was 40% or 60% or some other number. So we could buy other gold miners and we could avoid the risk. So we actually chose to sell all of our Russian stocks actually in January of this year. And it wasn't because we knew anything. It's just a way of just limiting risk. So we've always got to be on the lookout for limiting risk all the time. On the other hand, we are there, as you say, to spot opportunities as well. And with the markets coming down, there's been opportunities actually for us to top up some of our holdings. We haven't needed to bring new holdings in. Our portfolio doesn't have much consumer bias anyway. Many of the companies we're invested in are continuing to do pretty well, irrespective of whether there's a Ukrainian conflict or not. So from that point of view, we've been absolutely able to top up some of our existing holdings. And most particularly, it's been quite attractive because we've had quite a lot of energy stocks, which have done pretty well. And bizarrely, some of the smaller energy stocks didn't move in share price. Initially, they didn't keep up with Shell to start with. And we've also got quite a lot of mining stocks. And again, there's worries about shortages of certain metals and other commodity stocks, including, of course, some of the food stocks. So overall, it's been an opportunity for us to have a bit of a turmoil. Turmoil means opportunity, and ultimately, hopefully, we can add a bit of value through that process.
I think that's, again, really interesting. So Hugh, your point about timescale is something we would completely echo with every investment decision. You've got to think about timescale. And Gervais, I think your point about focusing on the risk, it's not necessarily acknowledging what you, or trying to make predictions or saying that you know something, it's deciding whether or not that risk is worth the reward, which I think is really, really interesting thing to say. Okay, so there's lots we don't know and there's lots we can't predict, but is there anything we can say with a reasonable degree of certainty now? So for example, we know that if the conflict ended tomorrow, it's not, you know, relations with Russia wouldn't suddenly go back to what they were before. So will there be some longer term impact as a result? And whilst Russia has been the focus of lots of client questions recently, interestingly, we're now starting to get a lot more queries about investing in China as well. After all, at least China has notionally, at least, aligned themselves with Russia. But China is much more integrated in the global economy, second largest economy in the world. So can we avoid investing in China? Should we avoid investing in China? Again, I'd like to hear Hugh's thoughts to begin with, please.
Sure. I mean, similar to you, Mike, we've been getting questions along a similar line. And I think point number one here is to be really clear that we as investors can't try and overlay our preferences on what we think our clients would want. So if a client comes to us and says, we don't want to invest in China, then it's our job to offer them the options. So, everyone has their own take on where they want to invest and where they don't. And I think we have to respect that as point number one. That being said, China is a huge market. So you're looking at the second largest economy in the world. You're looking at an equity market that's about $12 trillion in size, a fixed income market that's even bigger than that. We're expecting China to overtake the US as the largest economy in the world in the next 10 years. So simply taking a blanket approach and saying, I don't want to invest in China whatsoever, in my view, is quite a blunt way of trying to tackle things. Now, many people are coming at this issue from a sort of ESG lens, an environmental, a social, a governance lens. Like, how compatible is China within that sort of framework? Can we faithfully put our money into Chinese companies and be confident of getting it back and be confident of the political structure in which it's working? Now, what I'd say on that is that when you look at the differences across regions or the differences within regions, we tend to find that there's much more of a variation in terms of the quality of governance or the social considerations or the environmental approach of companies within a region than there is across a region. And the reason I draw this out is to say that if you're thinking about the ethical nature of your investments and you want to try and tilt your portfolios accordingly, our view, therefore, is that you are more powerful in doing that by investing actively within a region and picking the winners and losers within, say, China, than trying to say, I think the UK does a better job on ESG issues than China, and therefore I want to avoid China altogether and invest entirely in the UK. So I think when it comes to any of these types of problems, be it linked to Russia, be it linked to social factors, be it environmental factors, it's about active management. It's about picking the companies that you have absolute faith in and trying to tap into that long-term investment opportunity that we do see in China over time. But you can be much more powerful in terms of picking stocks within the market than you can, in my view, by saying, right, I'm going to avoid country X and instead invest in country Y, because actually at a country level, the similarities are fairly large. We're having similar discussions at the moment with clients who are saying, well, what about defense stocks? How do they fit in? Are they weapons or are they trying to promote global security? Now, again, it's not our place to try and implement our views onto clients. We need to offer a range of different options, but we find that generally these types of decisions can be much more effectively managed on a stock-by-stock basis, doing the kind of bottom-up fundamental research.
But just generally, and I completely accept the point of view there, but do you feel like we could be at a bit of a turning point where some of those previous kind of globalization trends, let's face it, we've had plenty of kind of trade wars and all the other things over the last few years anyway. But, economies have realized that they're too integrated with Russia and obviously a hostile nation. Might we decide that we are too integrated with China, which is, we're not exactly that friendly with at the moment as well? Might we see a bit more of a separation?
Yeah, I mean, in a way, I think this is really accelerating a trend that was already in play, because companies have learned over the past 2 years that if your supply chain is too concentrated and you're overly reliant on one factory in one part of the world to make the products that you want to sell, then that's not good management. That's not a resilient supply chain. You're going to leave yourself very vulnerable to a shock. And that could be COVID, that could be a political shock, who knows what that might be, but you're going to leave yourselves very exposed. So what we're seeing is a trend for companies to be trying to focus on the resilience of their supply chains, and that can mean broadening geographically. That might mean trying to ensure that you hold more inventory because you know that you don't want to run the risk of a factory shutting down and leaving you short of a key part. So yes, I think that trend is accelerating. The one specific point on China that I'd bear in mind here is lots of the outsourcing that we've seen in recent years isn't just because you're turning to cheaper labor, but rather it's because you're trying to get closer to the end consumer. You're trying to move your manufacturing process to tap in to the emerging Chinese consumer. And when we look at forecasts over the next 10 years, there's been some great work on this that suggests that the Chinese consumer class, the middle and the upper classes, is going to grow by more than the current number of US citizens today within the next decade. You're looking at over 330 million new joiners to the Chinese consumer class over the next decade. And that's why I feel like China really is too big to ignore. But I acknowledge that stock selection and that kind of fundamental bottom-up research within the market is still really important today.
That's a really interesting fact. I'm really just trying to process that. Gervais, over to you. I mean, obviously, you mainly invest in the UK. But as we were saying, even if you avoid Chinese shares completely, that doesn't necessarily mean you're avoiding China, because there's so many Western companies that are just so integrated in their supply chain. So is that something that concerns you? Is it something that you talk about when you're talking to those companies that you invest in? And maybe picking up on Hugh's point as well, is there an opportunity even for UK investors to be selling to some of those that emerging Chinese middle class?
Absolutely. I mean, the Chinese economy has obviously been a huge stimulus to growth over the last, particularly 25 years. Global growth has been excellent with globalization anyway, but it's been stimulated and accelerated probably by Chinese growth. Coming back to the main points, the first is that, I mean, you've got stocks like HSBC in the UK, which in itself is probably dominated by its Chinese aspects. Now, there's plenty of other banks in the UK. As it happens, we've already taken the decision not to invest in HSBC at the moment. That's not because we are certain that anything's going to happen, but the Chinese could, if they were just didn't like what the UK's government was doing, could just turn up in the morning and just say, by the way, that bit's ours. Don't get me wrong, the people in the UK, the bank is ring-fenced in the UK. UK customers will be okay on that, but it means that here's a company which is 5 to 6% of the FTSE 100. And you could just get an event which would change its value dramatically. And we don't need to hold those. As I say, there's plenty of other banks in the UK we can buy and sell if we want to invest in it. But going on to your second point about investing in companies with opportunities, yes, of course, the great advantage of investing in UK quoted companies is they can manage these risks. There's a company in our portfolio which reported this morning, a company called CML. It's involved in computer chips, and it does have some Chinese operations. It's actually quite a small company. It's only about 60 million market cap. It's got about 22 million of surplus cash in its balance sheet. But it is possible that the Chinese, if they got very grumpy and they could find that it's difficult to export, or they're not allowed to do things in China. So it can be something which we can worry about, and it might affect the share price. But the great advantage is the share price is in the UK, and we may not like the share price, but we can take profits if that's what we think the right thing is to do. So coming back to that, I think some of these international risks can be better managed actually by buying companies which actually have those aspects within the portfolio, and they manage them, and the share prices will move as appropriate. And it's a case of, particularly with portfolio management, of having your risk spreads. That's the whole point. You don't do it all in China, you don't do it all in the UK. You want it in a huge range of different areas, and specifically that's the opportunity as we see it. So coming back to the point which you're saying is, ultimately, we think that going forward, there's going to be less growth coming from not just the world. We think interest rates are going up, inflation, etc. But actually, you do sometimes get points where large economies do just go ex-growth. If you remember, Japan was the second largest economy in the world. A mix of demographics, i.e. older people, and high debt levels meant that the Japanese economy just went ex-growth rather suddenly on the last day of 1989. It's not usually a single day, but it sort of appeared to. And the stock market in Japan has never gone up since. My own view is actually that's exactly where we are with China. My own view is that China is going ex-growth right now. And I don't think we will see much growth from China for the next 10 or 20 years.
That's really interesting. Hugh, maybe I'll give you a chance to respond to that. Are we now at a point where China perhaps might be less important for global growth? Should we be looking for the next China, somewhere like India or somewhere else that might see stronger growth going forward?
Yeah, it's a tricky one. So I think the first point I'd make on this is to say, yes, China is slowing. I completely agree with Gervais on that. We're not going to see the same spectacular rates of growth that we have done for the past decade, nor is China going to be as big a support for global growth as it's been for the past decade. But that being said, when you look around the world in terms of that growth differential, I'm not sure we're going to see that spectacular level of growth within developed markets either. So that kind of relative outperformance of the Chinese economy versus developed markets could still be there, albeit at a smaller magnitude. But I think there are some fair challenges to that in terms of to what extent are policymakers going to allow the economy to grow, and also just the nature of the growth, right, is really important as well. Is it all about quantity? Is it about China just trying to drive the real estate market and investment through the roof and creating lots of growth that way? Or are they focusing on a higher quality of growth that could actually feed its way into the stock market in different ways? So lots to debate there, but I take the point. China is slowing. Personally, I would say on a relative basis, it still looks quite attractive. But picking up on that second point, Mike, India is a great example. It's earlier in its trajectory, but it's definitely on an upward trend in terms of its share of global GDP. We have lots of charts in the guide that look at this, but India is, I think, more favorable in terms of demographics and an earlier phase of the story. So plenty of potential there as well to tap into really the rise of the emerging consumer. It's the same idea. It's that person who's taking out their first bank account or their first insurance policy, or perhaps upgrading their preferences from the budget line in the supermarket to the middle line in the supermarket. It's all of these exciting types of opportunities that get our emerging market managers up in the morning.
Really interesting. So just Gervais, come back to you just quickly on before we finish on that part of the topic. So you mentioned earlier that you sold your Russian holdings just because the risk was too great and it wasn't worth holding them. Could you ever envisage that being a case of a China-linked holding or somewhere else in the emerging markets?
Well, as I say, I mean, we've already, we haven't had HSBC for many years, so that we're already at that position in terms of that company. Yeah, I mean, I think the nightmare is if you look back 30 or 40 years, there used to be a lot of currency controls. It wasn't so much just the economy risk you were taking, but if unfortunately inflation was high and they ran out of cash as a country, they just put on exchange controls and you couldn't get your capital out. And we think that is a really proper risk to really be worried about. And it's therefore we really are much more cautious about many of the emerging markets. We don't think we agree with you, actually. We think the developed markets aren't going to do well at all either. It's not that they're going to necessarily have lots of downside, but there may not be much upside. And so it's down to stock selection. And Hugh's made that point as well.
Absolutely. Well, thanks to both of you. Well, on that note, you mentioned inflation as an aside there. So let's move on to the second part of our topic for today, which is the cost of living crisis. Because one thing we can say about the war in Ukraine is that it's added to existing concerns about energy prices. We were already seeing high levels of inflation, partly as a result of pandemic-related issues. So, Gervais, how worried are you about inflation causing an economic downturn, perhaps here in the UK? Clearly, as the cost of essentials like food and energy go up, people surely have less money available to spend on other goods and services. So are you seeing any impact on that in some of the companies in your portfolio?
Yes, I certainly am. I think the interesting thing here is that the pandemic itself, and obviously subsequently the Ukrainian conflict, is leading to an economy around the world which is less productive than it was previously. Offsetting that to some degree in the short term, we've had extra cash. So there's extra cash and there's less production. There's a mismatch between demand and supply, and that's why we're getting inflation at the moment. And the way that you address this is possibly to raise interest rates, which suppresses demand and brings it back into balance with supply. And that's where we are. But it's a pretty uncomfortable feature because obviously all of us have to learn to do with it slightly less. And most particularly, it's retrogressive. It's regressive. In other words, those with the lowest incomes are probably feeling it a lot harder than those with the higher income. So from that point of view, I think we've got a really difficult sort of problem here. I do expect a recession in the UK and indeed in the US late this year or next year, basically because I think that we have to raise interest rates until we get suppression of demand. And that's really what a recession is. Clearly, the great advantage of quoted companies is that they have strong balance sheets, which means that they're in a position which they can withstand pressures. I am very anxious, to be honest, about a lot of private businesses which might have a certain amount of debt they took on when debt was cheap. debt costs going up, wage inflation is quite strong, especially amongst some of the less skilled workers out there. And so I think there's some real margin pressure coming, big and small companies going forward. And I think that's going to be a challenge for companies. And if you start off with a stronger business, perhaps with a business generating cash, then you're in a business where hopefully you can withstand the pressures. You may not be as successful, but you can withstand the pressures. And most particularly, better still, you can acquire assets from the receiver. You can keep the teams in work. You can invest in them so that they can deliver the full cash payback and actually enhance your ability to generate cash. The UK market is very, very well positioned. It did this in the 70s and was one of the top performing markets in the world. And I do expect going forward that actually, having had a long period when the UK market has been outpaced by others, I think the UK market itself is now going to enjoy a period of outperformance. It already has this year, but I think that's just a start. I think this is a trend which will be with us for as long as inflation is there.
Yeah, that's really interesting. So Hugh, it'd be interesting to get your view. So Gervais, very worried that we'll see a recession here in the UK. What about the global picture, Hugh?
Yeah, I mean, one point of evidence on this one, I was speaking at a conference at the back end of last week, and I said to the audience, today is the last day to submit your energy meter readings if you want to lock in prices on the previous costs. And I've never had more people take notes in any one of my conferences. Everyone took out a note and said, right, I've got to do that when I get home. So clearly it's on the minds of UK consumers at the moment. I'd make a couple of counterpoints that primarily linked to the labour market, because obviously the cost of living is going up. It's interesting that we no longer talk about inflation, we talk about the cost of living crisis. You know, the press have really latched onto this theme, but wages are rising as well. So that gives you some offset. They're not rising enough to fully compensate for the pickup in prices. But in the UK, you've got wage growth running at 5-6%. Similar story in the US. And so that's really important because it means that the squeeze on consumer incomes is not as great as it would be otherwise if wages weren't growing. And why are they growing? Because we have labour markets that have recovered very strongly post the pandemic. You have pretty much a record number of job vacancies in both the UK and the US. And if you look at the ratio of available workers to fill those job vacancies, the labour markets look historically tight. And so the answer for companies has been, well, if I want to be able to hire workers, I have to pay higher wages. So that's one offset. I absolutely agree with Gervais that the consumer outlook has deteriorated this year, but rising wages are helping to offset some of those risks. The second is something I mentioned right at the start. I come back to the policy response, because so far what we've seen from the UK government and others has been relatively limited in terms of their willingness or their ability to really shield consumers from the full effect of the energy price. But I do wonder whether this is being misinterpreted slightly. Bear in mind, in the UK, the Chancellor has been wanting to get rid of the spring statement for several years, but he keeps finding another emergency that means people say, okay, well, you're going to have to go again. You're going to have to announce a spring statement. You can't just wait until the autumn. So that, I think, is important context when you think about what was announced just a couple of weeks ago in terms of the cuts to fuel duty, for example. Generally, the coverage of that was to say, well, that's nowhere near enough. And it's true that it wasn't. But bear in mind that that's the Chancellor speaking when really he'd like to be saving the firepower for the autumn budget. So I do expect that policymakers will do more to try and shield consumer incomes. So to sort of round that off, the risks to the consumer have clearly increased. We know that growth is going to be weaker this year than previously expected. And we know that inflation will be higher and higher for longer because of what we're seeing going on in Russia and Ukraine. That puts the UK and European economies in a more rocky place, but I still don't think a recession is a given for this year, given A, strong labour markets, B, all of the pent-up savings that people have created over the past couple of years. More than 10% of GDP, we think, has been parked in the UK as a result of the pandemic. And then C, keep an eye out for that policy response, because it could be that there's more on the way which will help to dampen the impact on consumer spending.
Well, it's interesting you're going to say that, because I was going to pick up on that point anyway. So one of the things Gervais perhaps might be that give us a little bit of comfort is that, a lot of people have managed to increase their savings, obviously only in a certain selection of society, but they've managed to increase their savings throughout the pandemic, and perhaps therefore has a little bit more headroom to deal with a short-term increase in prices. So that's just one point. It's just worth pointing out there. But I'd also just interesting to get your point that if companies are having to pass, make larger pay rises to people to counter that inflation, then surely that is also putting pressure on profit margins at a company level too.
Absolutely. I mean, profit margins, they haven't come down a lot yet, but I'm expecting them to come down quite considerably, actually. If you look back over the last 25 years, actually, we've had a surplus of labour in the developed markets, partly because we've exported a lot of our manufacturing jobs to overseas countries, and partly because we've closed coal mines and other high volume employers. And so we've had a surplus of labour, and that's actually meant that profit margins across the UK companies and indeed US companies have actually increased. I think what we've seen in the last 2 or 3 years is as we've changed our behavior, particularly as we've moved online, bought a lot more online, there's a lot more people putting things in parcels in various warehouses around the UK. There's a lot more people delivering those parcels. So I think that's a feature which has led to the market to tighten in the UK and in the US. And going forward, of course, we won't rely in the same way on international suppliers. We are going to manufacture more locally in future, and there will be more demand for jobs in the future coming forward. So my own view is that labour costs will rise quite hard, particularly, as I say, in some of the more junior roles. And that's a great thing because, as Hugh mentioned, we do need some increase. But I still don't think it'll close the gap, because the truth is that the global economy is less productive than it was 2 or 3 years ago. And so from my point of view, whilst I do think that the government may be careful about increasing spend too much, I think what you will find is as unemployment picks up eventually, perhaps that will suppress wage growth at that stage, I think people will find it harder to make ends meet. I think we will see more strike action, just like the 70s. This isn't new stuff. And I think we're going to get into some quite difficult times at that stage. What happened in the 70s was actually quite interestingly, in 74, there was a big pulse of inflation. Everyone said it was one-off, transitory at the time. And actually the bond markets held up pretty well. It was only in 77, when unemployment was high, and the government said, I can't bear this. We've got an election coming up. I need to release the brakes. They let cash come into the economy. They brought the interest rates down. And at that stage, of course, that's when inflation came into the UK economy on a generational basis. I fear the same is going to happen this time as well. The final point is, how do we find companies which are going to be able to resist margin pressure? And the way that we select them isn't just they have strong businesses and delivering good services, but most particularly, we've been selecting companies for the last 7 years on the basis they don't just deliver good, but they deliver outstanding customer service. We think nearly every business is going to come under margin pressure. Even if you are delivering outstanding levels of service, you may not be able to resist margin pressure, but at least you've got something to argue with. And so we look for management teams which are very much aligned with the frontline staff. You need engaged and motivated staff to deliver outstanding service. And what's interesting is when we meet companies, nearly every presentation we meet has nothing about the staff motivation or engagement with customer service. And we ask, is it part of the board papers? How could you possibly make a board decision without thinking about customer service and all that kind of stuff? And we do get a lot of management teams who sit fairly in like a cocoon of a C-suite, and they're just nowhere near the front line. And I'm afraid those businesses are going to find the next few years really uncomfortable, in my view.
Yeah, absolutely. Customer service is absolutely key. Quite agree. So obviously, Gervais, you've outlined a little bit of a bearish picture there. But I guess one of the factors that really will make a big difference is how long this inflation lasts for. So, I suppose, Hugh, maybe come back to you to begin with on this. Is inflation now back for good? Is it something we just have to put up with? It's going to be, back for the long term, or is it just a confluence of temporary factors all caused at the same time? Because surely that makes a big difference to the outlook that we see.
So, without wanting to sound too much like an economist on this, am I allowed to say yes to both of those? Let me explain my answer to that. So, will we see inflation at 7-8% indefinitely? No, we won't. Because remember, inflation is a year-over-year comparison. So even if we locked in all of the really high prices that we have today and roll forward a year, you then have no inflation because there'd be no annual change. So in order to keep inflation going at 6, 7, 8%, that's quite hard in my view. I think that over time, naturally, that headline rate is going to come back down closer to the central bank's targets. So that's yes to one part of your question, which is some of this transitory and will it fade over time? Yes, I think it will. The challenge for the central banks is that just as you have some of those transitory factors fading, you have some of the more structural factors with inflation starting to pick up. So the labour market is a much stickier sign of inflation. Once wages start rising, generally they keep rising, generally prices keep going up. Housing costs are another one that tend to be more stable. Food prices are another part of the basket that are starting now to show signs of increase. So I think what's going to happen is that just as some of those transitory factors start to fade and we start moving back towards more sensible levels of inflation, away from the 6, 7, 8%, the challenge is that you're not going to get straight back down to the central bank targets. I think that personally, living in a world of, say, 3% inflation is more likely than living in a world of 2% inflation, because even after you take out that energy cost hit and you take out semiconductor shortages that have been putting pressure on used cars, or everyone's got their holiday desire out the way after the past couple of years and hotel prices start to normalize, you're going to see some of the stickier parts of the inflation basket accelerating, and therefore leaving us with inflation which is still above central bank targets, even if it's not at the eye-watering levels that we have today. So that's why I say, is inflation transitory? Yes. Is it here to stay? Yes, albeit not at the crazy levels that we can, you just can't see inflation at 8% indefinitely without having a recession that brings you back down to a reset.
Interesting. I'd probably echo some of those responses. But Gervais, what about you? Do you think we get end up with this wage hike spiral that could then cause longer term inflation?
Yeah, so I mean, to some extent, I agree with you. I think wage inflation is a major issue. It's coming through at the bottom end. I was talking to a defence business the other day before the Ukrainian conflict, and they came to an end of a program and they made some of their staff redundant because the program had finished. It was about 10 or so. It was November last year or something. And I spoke to them in January, and they were very pleased to tell me that those 10 staff had found new jobs. What they were less pleased about was that on average, they got a 50% higher salary than they left on. And I think there's a large amount of change to come through in all sorts of industries, which probably are going to be more challenging than we all like to think. So as a starting point, I think that's true. But I do think that, as governments are careful with bad interest rates and they try and suppress demand, I agree. I think inflation will appear to die down, but it'll only die down until it gets too hot in the kitchen. And then I think, like every time, it's always the same. Ultimately, the politicians want to be re-elected, and they will ultimately release the brakes for that reason. And so you'll get a cycle coming back. And once you get 2 or 3 cycles, of course, people do think it's there for the generation. And that does make a big difference, not just to bond yields, and of course, the valuation of government debt, but of course, valuations of all assets, which is why I'm so cautious about asset markets. I don't think they're going to produce much return going forward, other than by stock selection and finding companies which aren't just able to survive, but thrive in this uncertain world. And as I say, quoted companies with their strong balance sheets and those which are able to acquire assets from the receiver, I think are going to be actually well placed to achieve ongoing returns in spite of these fairly unpromising background prospects. Yeah,
very interesting. Well, so we sort of hinted at it over some of the previous questions, but the traditional way, of course, that central banks try and combat higher inflation is put up interest rates. But surely when you have, such a cost of living crisis, all putting up interest rates is going to do is perhaps, tip us into that recession that you're worried about. So, Hugh, should central banks continue putting up interest rates in this sort of environment? Is it going to make any difference on inflation anyway, if it is caused by some of these external factors? What could be the possible impact?
So you're right, Mike. The central banks cannot control energy prices, just as in the same way they can't control Cornish hotel prices. Higher interest rates are not going to have an impact in terms of the headline inflation levels from month to month. This is supply side driven, this is more structural, this is out of their control. So they know that in putting up interest rates, they're not going to have an immediate impact in terms of bringing inflation straight back down to target. That being said, should they be raising rates today? I think about this another way around. Is the economy weak enough to justify having such low interest rates? Well, the labour market is strong. We know growth has been pretty strong. We know that inflation is well above their target. So I think in the central bank's mind, they're saying, well, hang on, we're still very close to where we were at the peak of the pandemic when this economy needed the maximum amount of support. Therefore, we want to get back to a more neutral level of policy, a more balanced level of policy. So I think they are right to be raising interest rates. And I think they'll keep going until they see one of two things. I think they'll keep going either until they see that growth is materially starting to weaken, because eventually higher interest rates are starting to hurt demand. little sign of that so far, or they'll slow down because they see inflation moving sustainably back towards their target. And again, little sign of that so far. Now that balance is going to vary a lot in terms of different countries. So if you look at the Bank of England now, they're already saying we're becoming quite concerned about the growth outlook weakening. Maybe we need to take a slightly more gradual path than we'd previously expected. Whereas someone like the Federal Reserve in the US, much less dependency on Russian energy, therefore a much more resilient US consumer, is saying, well, we can power on with interest rates because the likelihood of our growth outlook being knocked off course is that much lower.
So Hugh, where do you invest in that kind of environment then? If you've got a period where you've got higher inflation, perhaps slowing growth, and interest rates going up, are there any asset classes that you really favour in that scenario, or anything that you would really want to avoid?
Yeah, I mean, I'm glad I'm on with an equity portfolio manager rather than a bond portfolio manager, because I think point number one is fixed income is really hard in this environment. You're losing money. You've had a record loss in US government bonds to start this year in the first quarter. I think it was the weakest quarter since the early 1980s in US treasuries, US government bonds. So fixed income, you have to tread very carefully. I think you have to be thinking global, you have to be thinking flexibly. Long only fixed income investing looks like a really difficult spot to be in today. Real assets look much more attractive. If you can find assets that have contractual linkages to inflation built into the contracts, so things like infrastructure, for example, then that seems to me to be a good place to be looking in the current environment. And then within stocks, obviously keen to hear Gervais's views, but from my perspective, a rising yield, they don't have to be negative for the stock market as a whole, but they can have a big impact on the types of companies or the types of sectors that tend to be the market leaders. So you see quite a different stock market leadership to the one that we've had over the past 10 years of that low growth, low inflation world, where people were very willing to pay big valuations for technology companies, for example, that could grow in an economy that wasn't really growing. So I think stocks can be okay, but it's going to change the leadership underneath the surface.
Yeah, interesting. Well, let's pick up on that. So we'll come back to you, Gervais. So just on the point of rising interest rates, certainly there's certain types of stock, as Hugh's mentioned, that tend to do quite poorly in that environment. But I guess you want to be careful about looking for, looking at companies that are too indebted, for example, wouldn't you?
Absolutely. I mean, I think we've all learned over the last sort of 10 and 20 years that if you put extra risk on the table, you get extra return. And that's not just in terms of bonds, where people have bought duration, long duration bonds rather than short duration bonds. I think it's also applied to share prices. If you can get a company which is growing more quickly and the present value of that future growth is discounted as bond yields come down, then of course, long duration, long high beta stocks such as the NASDAQ stocks have obviously been very good. But again, I think that's going to be under enormous pressure. And then thirdly, of course, you're looking at companies which actually in themselves carry all sorts of risks in terms of they've got cost inflation coming through, perhaps, and they can't manage that because they're under pressure in their own businesses. And things like some of the old zombie companies, which are companies which are struggling to actually even generate enough cash to pay for the interest charges even before they've gone up, are very vulnerable. So that's there's all sorts of opportunities out there which we must avoid. Most particularly, what's interesting is actually many of the things which have done well in the last 30 years might not do quite so well going forward, but actually bizarrely, many of the things which haven't done well in the last 30 years might do really well. So I think manufacturing will be quite an interesting area. I think some of the mining and some of the oil stocks, of course, we are thinking about moving into a low carbon world in the future, but we have to have a transition period from here to there. So all of those kinds of things, real assets, as Hugh said, are likely to do well. And perversely, things like property, actually, if you go back to the 70s, property did quite well because you got rate increases on your rentals, which didn't keep up with your cost of debt, and therefore actually property companies did well as well.
Interesting. Well, I think one thing maybe just while we finish is, I mentioned this to both of you off air, if you like, that Hugh, one of JP Morgan's, interesting points of data they put out recently, looking at the types of stocks that tend to do well in rising rate environments, smaller companies was right at the top of that list as saying the one that tends to do really well. But certainly here in the UK, we've had quite a difficult period for the smaller companies. Whereas, the FTSE 100 has done pretty well, maybe the mining, the energy stocks, etc. has helped. But it's been similar in the US as well, hasn't it? So is there a reason you think that this time smaller companies so far haven't done quite as well in this rising rate environment.
Yeah, my suspicion in the US is that it's quite closely tied to the infrastructure plans that Joe Biden has been trying so hard to get through and has really been failing on. So when Biden was first elected, there was all of this big hope that he was going to not only pass stimulus bills to help lock in the first parts of the recovery, so things like more stimulus checks and more spending on tackling the pandemic, but then after that, he'd be able to pass these big infrastructure packages that would be multi-year spending plans with a big tilt towards rebuilding US infrastructure, things like renewable power, the big transition in the grids that's required, et cetera, et cetera, et cetera. And generally, you saw small cap stocks following the prospects of that infrastructure bill quite closely. And so they were really rallying quite hard in the period where we were at kind of peak excitement on infrastructure. And ultimately, what we found in the US is that the very, very narrow margins in Congress that Biden is working with has made it very difficult for him to really get anything through. So I suspect that despite the kind of historical evidence that we see, which is that generally rising yields do favor small caps, it's been a bit of a timing problem for the US in that we had lots of hopes about infrastructure spending that should have had a big positive impact on small caps previously that has since really fizzled out.
Yeah, so we've seen another period where those big US tech giants have carried on to outperform. So, Gervais, small companies for a rising rate environment?
Yes, I mean, if you look back, actually, what was interesting about small companies is when we had, a recession back in 2020 with the pandemic, small companies, being young companies, can continue to grow. And so many of the companies which were able to not just survive, but actually thrive, were quoted small companies. And they had a very good run, not just in 2020, but early 2021. We have seen them peaking out, part because they've generated so much profit. People are taking profits. There have been quite a lot of companies, particularly in the second half of last year, which came with secondary issues. They were IPOs. They're looking to list new companies. And there was probably a bit of indigestion in the marketplace. And then more recently, we've seen bond valuations peak out a bit, and that's dragged down small companies. So they have had a bit of a sort of slower period in the last 12 months. But most particularly, absolutely, the great advantage of smallness is that it's not as reliant on bigness. It's not reliant on the globalization. It's not reliant on the global economy. There's opportunities for it to run around the feet of the majors. There are opportunities for them to grow even when the world's not growing. Often they're involved in new areas, which mean they're in a period of structural growth rather than cyclical growth. We are tremendously upbeat about the potential for small companies. And I think we have to be quite careful with definitions here. What most people call small companies are £3 and £5 billion companies listed in the UK or US. But of course, in the UK, we're nearly unique in the world in not just having small companies, but really small companies and microcaps. And these are even better positioned, bizarrely, being quoted. They can raise external capital. They can raise cash to actually invest in new opportunities at a time when investment was restricted because most companies don't have good balance sheets. You tend to get a better return on capex. So actually, if anything, we are not just upbeat about the UK, we are incredibly upbeat about the potential for UK, not just small and micro cap companies to outperform because they're coming from such a low level, having been out of fashion for the last 30 years.
Well, that is a great note on which to end the first part of our discussion. So, I could speak to you guys all day, but we did say we would give the audience a chance to ask some questions as well. So hopefully I should be joined by my colleague, Ben Rogers, who should be able to put the audience questions to our panelists. Ben, are you there?
Yes, hi. And firstly, thank you both to Hugh and Gervais for taking the time and for sharing your insights today. I think I speak on behalf of everyone when I say that it's been really insightful. Interestingly, the first question, which I had lined up, I was going to direct to yourself, Gervais, which was from our client, Brian, which was in relation to the alternative investment market or the AIM market, and your views around whether it's a good time to invest during a period of higher inflation and reduced demand. However, I think you very succinctly summed up that answer.
I wouldn't mind.
Comments?
I could add a few comments, actually. The first is, actually, bizarrely, the AIM market has been dominated by new issuance. So during periods like .com, it brought lots of companies in, and many of those companies actually weren't very productive, and they ended up being disappointing. Back in the 2005 and 6, there was a lot of very early stage mining companies, which again didn't prove very productive. The strange thing about the AIM stock market, since it was listed first set up about 25 or 30 years ago, is it hasn't gone up. as I say, the things which are going to outperform are going to be things which have been overlooked for the last 25, 30 years. I think the AIM market isn't just well positioned, it's very well positioned. Now, you've got to avoid some of the high beta stocks, some of these kind of extra growth kind of loss-making companies, but there's a lot of regular companies which are generating cash, surplus cash, which I think are going to do well. And as I touched on earlier, as you say, ultimately smallness is going to win out. So I'm very, very upbeat for the AIM market specifically to be a really strong market, in contrast to where it's been for the last 30 years.
Hugh, I know it's not really your area, but what does JP Morgan think about investing in the AIM market?
Yeah, I echo lots of what Gervais has been saying, actually. I think on small caps, the margin point is a really interesting one at the moment, because lots of people have been sort of challenging that view on small caps with me this year and saying, well, hang on, if we're worried about corporate margins, then should we not be worried more about small companies? Because surely they're operating in smaller scale, and so perhaps they don't have the same kind of capacity to squeeze more out of what they're doing as the mega caps who might be able to tighten up their production processes slightly more. And I think the challenge to that at the moment is that when you look at how companies are able to defend margins, historically you have two main options, right? You either do more with less, so you manage to make your production more efficient or reduce your workforce and still produce the same amount of content, or you simply say, well, my prices have gone up, so I'm going to pass those prices on to my consumer. And it comes back to Gervais's point about customer service. What we're seeing in the post-pandemic economy is that the way for companies to defend their margins has primarily been to simply say, our costs are going to have to be higher because we're seeing a shock across the board, and therefore we're going to defend our margins by feeding that down to the consumer. And that, I think, does lend itself to the small cap outlook, because what we're seeing in this economy today is that it's not the mega caps who have that pricing power, it's spread right across the economy. Anyone that's been, I had my shoes rehealed the other day because I'd worn them out coming back into the office, and I found that the cost of that had gone through the roof. And yet there's someone there saying, well, I'm sorry, I've been closed for a year, so my prices have gone up. And you say, that's life, right? I don't have an option. It seems like all of these small businesses in the UK at the moment have much more pricing power than a traditional economic squeeze where you might be tending more towards the large caps.
Yeah, really interesting point. Ben, have we any other questions?
No, that's it for now. I will keep it open, but at this stage, we've not had any further questions. Okay.
Well, great. Well, if anybody does have any further questions they want to submit to us afterwards, then please do so, and we'll make sure that we answer them. But in that case, I would just like to say on behalf of all of us at Equilibrium and everybody listening, so thank you, Hugh, thank you, Gervais. It's been really, really fascinating. I've really enjoyed it. Hopefully everyone's enjoyed themselves at home. If you did find it interesting, then please feel free to tell your friends. We'll have a recording available on our YouTube channel shortly. So please do share that with anybody you think would be interested. We'd also appreciate it if everyone would complete a short feedback form after the event. It does really help us to target these events for future. And of course, we will enter you into a champagne draw if you do fill in one of those forms. So it's well worth doing. So that just leaves me to say thanks to everybody for listening. Thanks to our guests today, and we'll see you again next time.